China's rulers are used to battling great tides of liquidity that threaten to wash their authority away. So much so that the country's earliest political stars were those who managed to tame the floods unleashed by the fearsome Yellow River. Even today, the character for political control shows the sign for water, in the form of 3 drops, next to the sign for a platform or river dike. Now, though, China is facing a different sort of liquidity challenge. Torrents of money are flooding out of the country to find safer havens abroad. Some of this money is in flight from an anti-corruption crackdown, but most of it comes from investors trying to get more bang for their buck overseas than they would inside China. Goldman Sachs estimates that in a single year, people or companies took or smuggled out of the country as much as 1.1 trillion US dollars. That is quite a chunk of cash. To put it into context, $1.1 trillion would buy a fairly reasonable car for about 100 million Chinese families, or pay all of the yearly wages for about 122 million Chinese factory workers, or buy you about half of everything that China exported to the world last year. An awful lot of stuff. For a developing country like China, therefore, hemorrhaging that amount of money is really painful. This outward gush also depresses the value of the Chinese currency, the renminbi, against the mighty US dollar. And this has aroused the ire of none other than Donald Trump, who has threatened to brand China a currency manipulator and impose stiff tariffs on Chinese exports to America.
I like China.
So what is Beijing doing about it? Interestingly, its reaction seems to draw more from the flood control techniques of 5,000 years ago than it does from modern economic theory. First up, they're plugging the holes in the dike through which Chinese money is flowing abroad. The government is scrutinizing and in some cases blocking any overseas investment by a company worth more than $5 million. This vigilance has contributed to a collapse in the number of overseas deals by Chinese bidders recently. Foreign companies operating in China are also finding it increasingly tricky to send their profits home. The second strategy in liquidity management is to divert the flow. This is an enduring ploy. Even in modern times, when a river looks like it's going to burst its banks and engulf a big city, the authorities will intentionally breach the dikes in a more rural area upstream, so that that area gets flooded instead. The monetary equivalent of this has been playing out in the country's short-term money markets. Authorities have intervened to raise domestic interest rates, thereby enticing more investors to keep their money inside China. Of course, there is collateral damage, just as there is when a rural area gets inundated through an intentional breach of a river's bank. In this case, the losers are those Chinese companies that finance themselves by issuing debt in the money markets. They are having to pay more, and some are heading towards default. With so much debt around, a default domino, where one leads to another, is a serious risk. But all Chinese know that floods create losers. That is why the Yellow River is known as China's sorrow. Beijing's calculation is that it needs to inflict some pain to ease the torrent of capital outflows that threaten to sink the renminbi and exacerbate tensions with Donald Trump.